Most people think talk about life insurance is boring, or even worse, a ripoff. I used to think that too, but then I learned how wealthy people think. They use life insurance as a place to store cash, access liquidity fast, and keep their money compounding while they invest in real estate, business, and long-term opportunities. Today, we're talking about whole life insurance as a wealth tool and not just as a death product or a set it, forget it policy and something you buy without understanding how it actually works. My guest today is Brock Fortner, founder of StoneCentury Financial. Brock advises high-income families, entrepreneurs, and sophisticated investors across the country, specializing in cash value whole life insurance policies. He's also one of the only men I've ever had on this podcast, besides my husband, which should tell you about how much I trust his thinking. I'm Tamar Hermes, and this is the Women Growing Wealth Podcast. Let's get into it. Welcome to the Women Growing Wealth Podcast. I'm very excited today because we're getting into a strategy of wealth building that I think a lot of women do not understand, and that is the element of life insurance. And I talk about life insurance sometimes, not all the time, but today I actually brought on my partner that I work with in life insurance who basically has been doing this for since he was a wee one, which sounds very strange, but when he tells his story, you'll hear it. So this is actually also the second man that I've had on the Women Growing Wealth podcast. The only other man I've had on has been my husband. So you know that I really respect Brock and love what he does. Welcome, Brock Fortner, to the Women Growing Wealth podcast.
Thank you, Tamar. I feel honored the fact that I am the only other one besides your husband. That's awesome. Thank you.
There will be more, but we're very,
Yeah.
but you know, as long as there's women that we are interviewing and we stay so busy, you are my person when it comes to life insurance. I am licensed and I don't have the bandwidth to take on a company of life insurance on my own. And so I have aligned myself with you. And I would love for you to tell the listeners a story of why is it do you think you based on your history, all the things that you've done, can you just give us a brief overview of how well you know life insurance?
I can do that. I know it very well. I've been doing it, I guess you could say, since I was a wee little one. My my father is in the industry for a very long time. I think he's going on 40 years, one of the top producers in the country. And he really helped a lot of the different systems get off the ground when it came to life insurance, like infinite banking, like other planning systems out there. And so when I was in college, I was working on an accounting degree and I just wasn't feeling it. I didn't really know what I wanted to do. I just finished playing baseball and started finally asking questions of, what do I want to do with my life? And my father ended up asking me if I wanted to come to work with him one day and see what he does. And since that day forward, I was ready to roll. And I actually started when I was 18 in the industry. So I've been doing this for a decade now. So I've got quite the reputation behind it. I'm one of the top producers in the country for it. And I could not, it's as much as life insurance sounds boring, I find it so fascinating and talk about it, read about it every single day.
I love it. I love it. Okay. So you piqued my curiosity in terms of how much you love life insurance. And just tell me, most people do think life insurance is boring and it's something that you buy and forget. And that thinking is outdated. And can you talk about that?
Yeah, so I think it's outdated on many different fronts, but we've kind of gone through this cycle of, how life insurance plays into our world. So if you go back to, so first off, life insurance has been around for 200 years. And then if you go back to like 1940s when we had just gotten done with World War II, you would notice that about 50% of Americans held most of their money in life insurance or annuities. But then around 1980s is when most of corporate America transitioned off of pension plans or defined benefit plans and moved to defined contribution plans where the 401 came out. And so that became a big rise. Everything was about the stock market, and it has been for a very long time until here recently. Friends of mine like Dr. Tom Wall, who wrote a book called Permission to Spend, really details the fact that this is probably the greatest time to own dividend paying whole life insurance in the last 80 years because of the fact that our economy, when it looks at a portfolio for retirement planning, most people would hear, oh, just do the 60-40 bond equities portfolio split. But what they're finding is, especially in the last couple of years, is bonds and stocks or bonds and equities are moving in the same pace with each other. So now when the equities portion of your portfolio is down, bonds are down too. And so there's the usual hedge that we had been seeing that bonds produced isn't around anymore. And so what we're finding is the use of whole life insurance in a retirement portfolio is super beneficial. But then also for our higher net worth clients, it is one of the greatest places to hold and store your capital in your world because of many of the benefits that life insurance produces for us.
I love that. Okay. So you've touched on many points here, and I would love for you to talk a little bit about this component of using it as a savings vehicle. When we talk about bonds, we're talking about a return of roughly 3 to 5% over time. This was designed for any listeners that don't know. So the bonds were designed to offset the risk of stocks. They would earn around 3 to 5% historically. And now that bonds have become more volatile, we're looking at life insurance because life insurance for the last 200 years has been paying roughly 5.5%, and that's growing tax free. So let's talk about that.
Let's talk about that. So, when we talk about the life insurance, one of the things that, well, let's take a step back, just like a high level position here. When you think about whole life insurance, some people think it's complicated. It's actually very easy when you really break it down. So, if you think about real estate, if you were to go buy real estate, most of the time you'd buy a mortgage, you'd have a mortgage payment, and as you pay that mortgage payment, it builds equity over time. And then, you could sell the home for whatever the market price is. Now, with the equity in the home, you can get a line of credit against that to then go use elsewhere, right? Well, the same is true for life insurance. Just think about the premium as your mortgage payment and the what we call equity in real estate, we call cash value in life insurance, and then the sell price would be the death benefit, right? And so as that cash value builds, you're able to borrow against it and utilize it over time. Now, within the whole life insurance contracts, you have the guaranteed growth rate. So this is kind of like the worst case scenario if dividends were never paid. And that's going to be roughly, depending on when you purchase the life insurance contract, about 2.5 to 3.75%. That's like the guaranteed growth. Now, on top of that, you would then be given or awarded really a dividend. Now, dividends are not guaranteed until they're paid out, but you have to understand that these mutual life insurance companies have been paying these dividends for the last 178 years for some of these companies, right? Consecutively. And that is through the Civil War, through the Great Depression, through the Great Recession. Like they're going to pay dividends. It's really just a question of how much and how fast is your policy going to grow. Now, because we receive these dividends, we receive them on top of the guaranteed interest rate. So that is where the growth of the policy usually is going to come in to being around 4 to 5.5% tax free. Now, the caveat there is that life insurance cash values do grow technically tax deferred. Okay. Because of the IRS, if you put too much money into life insurance and the IRS notices, hey, you're not using this as life insurance, you're using this as a tax vehicle, you can produce what's called a modified endowment contract, where now your life insurance contracts acts more like an annuity or an IRA, where you would be taxed as you use the capital from the policy.
There is a way though, Brock, that you can make it where it's growing tax free if you don't take those dividends and you float them into the death benefit.
Correct. So
Okay.
one of the
Mhm.
things that we like to notice is as we build this, and this is why it's so important to work with someone who knows what they're doing, is as you build it, you want to know exactly where that tax line is, or what we call the MEC line, and fund up to or right underneath that MEC line so that you do get the characteristics that the cash value grows tax free. And as it grows tax free, there's two ways that you can access the cash value. One way is to withdraw all of those dividends. Now, like you just mentioned, you can take out all those dividends and they wouldn't be taxable as long as you take only up to the basis. So if you put $1 million into the contract, you could take $1 million out of the contract tax free. Now, our favorite way to access the capital within the life insurance cash values is by borrowing against the cash value. And in that instance, because loans are, not income, they're also not taxable. So you would be able to access the money tax free throughout your lifetime.
I love that. Now, we're talking about whole life insurance. There are many different types of insurance, and one of the confusing factors that comes up a lot has to do with term insurance and whole life insurance. One that actually has a term where it ends, and whereas whole life is your whole life. Can you speak to that?
Absolutely. So, really, there's two types of life insurance: term insurance, permanent insurance, whole life insurance. Term insurance, you will typically see that in different variables coming from annual renewable term, where the premium will increase every year or every so many years, like 2 or 3 years. There might be a term where it's a 10-year, a 15-year, a 20, or a 30-year. So what that means is your premium would be level for, let's say, 20 years, but then after the 20th year, those premiums would skyrocket. And that is where most people find they cancel their term insurance because it just becomes too cost prohibitive at that moment. And so with term insurance, it is pure protection. There is no other benefits to it. There's no long-term care. There's no cash value. There's no permanent death benefit. It is simply you pay the premium and then you only receive the death benefit if you were to pass away. Whereas with the whole life insurance, as you are paying premiums throughout time, it builds cash value and it has death benefit. Now, the one myth that we talk about a lot with many of the people that we work with is that you don't actually have to pay the premiums of a whole life insurance contract for your entire life. If you structure it correctly, you could pay in as little as 7 years and stop your premium without stopping the benefits of the life insurance.
Yeah, and that again speaks to when you're working with someone like Brock and anyone that comes in through me and my community, you need to understand what the variables are with life insurance, because there's many ways to slice it and dice it, and there's many needs. And even the other day, Brock and I had a client come in who someone else had proposed some insurance to her, and we basically said, you don't need that. And not a lot of people that are in this industry will turn clients away because she didn't really know the difference. She needed to be able to share what her needs were and have us listen to those needs and see really what was the best fit. And if the best fit was, hey, you don't need that type of policy right now, then that's what we'll deliver.
That's right. And sometimes all the time, you really need to be careful about who you're working with on these because there have been many times, and you hinted at this earlier, there's different types of permanent products as well. So there's whole life and then there's universal. And then in the universal world, you've got index universal life and variable universal life, which these things are now tied to the stock market in different ways. So variable universal life is definitely in the stock market, where index universal life is tied to the market, not necessarily invested in the market. But what will happen is oftentimes you'll have people come and sell you these type of policies and tell you that there's some type of whole life insurance. And it's not true at all because those are non-guaranteed products and they can fluctuate. Whereas with the whole life insurance, you know that you're guaranteed to grow. You cannot lose money in it throughout time. So you want to be very careful that the person that you are working with on this, if it's not us, that they are an expert in this world. They've been doing it for a while. They're not afraid to show you their own products of what they personally own, and they have a real knowledge and they're truthful about what it is that they're showing you.
I love that we're touching on this because I do think, especially for women, where we are really still new to this wealth world and we're definitely making great strides in terms of our positioning and understanding what makes sense to us, and we're actually darn good at it. In fact,
Totally.
statistically, we are better investors than men.
Right.
The thing that is really important here is to understand that just because someone is licensed and gives you information does not mean that that information is correct. And that's why you got to check the checker. You got to check us if you want. Check whoever you're working with. Check, 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 because you can only be too careful and too much of a steward of your own dollars. And that's something that I preach at Women Growing Wealth, which is that nobody cares more about our money than we do.
Right.
So let's talk even more about the myths and misconceptions about having life insurance. A lot of women don't see the need for it. They don't understand why there'd be a benefit to having children have it. Let's talk about some of that.
Absolutely. So, one thing that you just talked about, uh, it just has been ringing in my mind for a while is you need to take care of your money today because it's going to take care of you tomorrow. I love what you were just saying right there. But some of these misconceptions that you hear a lot of times is like, well, you don't need the life insurance, or your kids definitely don't need the life insurance. You've got to pay for the life insurance for forever. It's got a bad rate of return. It's expensive. It costs too much. Well, a lot of these are just out of context. Now, a lot of people, especially in our world, Tamar, do not need the life insurance. They have a lot of money. But if they knew what we knew about life insurance, they probably would want as much as they could get. Right. And so we've already talked a little bit about the myth like, you don't have to pay the premiums for forever, your whole entire life, to continue to have the benefits of whole life insurance. Now, when it comes to the cost of life insurance, this is probably my favorite conversation to have with people. They always say that life insurance, or whole life insurance specifically, costs too much. It's very expensive, right? Well, we have to understand what cost is and what your definition is. To me, cost is I put money into something and I get less than what I put into it, right? The price is different than the cost. Well, with term insurance, what it gets a little misconstrued is the price for term insurance is really low. However, the cost is really high because not only will you lose your premiums, you're going to lose your premiums and what they could have earned if you would have been able to put them somewhere else, right? Whereas with the whole life insurance, the price, yes, may be higher. It may require more money. However, the cost is low to none because you'll be able to access and use all of your premiums and then some if you do it the right way, right? And so when we think about life insurance, one of the things that a lot of people don't know is that there's really two ways that we buy life insurance, right? We either tell the insurance company the death benefit that we want, and they'll tell us the premium, or the more unknown way to do it is we build and design the premium that we want to pay, tell the insurance company, and they will tell us the death benefit that they'll give us. Now, in our conversations tomorrow, usually we are designing, building out the premium for the client that they want, that fits their world, that fits their needs, and then building out the policy for them in that area and letting the insurance company tell us what the death benefit is. So now, when it comes to a conversation of cost, well, cost isn't really a part of this picture because we've built it in a way that it's number one, we can afford it because it's within our free cash flow. We know that we can make these premiums, but we're doing it in a way that we have access to the premium dollars. We're not putting it in and not being able to ever touch those premiums again. We are doing it in a way that as we pay premiums, we can then access and utilize those dollars to go acquire something else. And so that comes to the next misconception, which we talk about. When we talk about whole life insurance, this is not an either or discussion. This isn't, hey, I either do stocks or I do life insurance. It's an and conversation. We want you to do stocks and life insurance. We want you to do real estate and whole life insurance. This should be a coordinated strategy with all the things that you have gone on.
I love that. And let's also talk about having policies on your children.
That's right. Thank
Having
you.
policies on the children is something that I never understood until later on when my kids were around 13 or so, and I wish I would have known about it because the benefit of these policies. I have a client that's an attorney, and what she did was she was able to fund a case that she was working on where she needed extra money with a policy that her grandparents gave her. She was able to use that money. She actually ended up winning the case for multi-million dollars and probably wouldn't have had access to the funds she needed for the case if she didn't have that policy.
Yeah, I think juvenile is what policies is what they're called. I'm going to call them kid policies. Kid policies are so beneficial, especially in the future, and I love them. Now, I need to take a sidestep here and talk about the importance of them because this has been coming up more now than ever before. And I don't like talking about it, but it's very important. And we're seeing it more and more often is yes, buying whole life insurance on the kids can be an effective wealth building tool. However, it is life insurance and there is a death benefit to it. And more now than ever, we're finding kids with depression issues, anxiety issues. We've got all these different mental things going on with children that we haven't ever really seen before, right? With all the social media and everything going on in the world. And it's causing the ability to acquire life insurance on kids to be a little bit harder. And so, if for nothing else, I have been talking about this more to have life insurance on your kids when they are young and you don't know what they're going to go through as teenagers and young adults so that they're not hindered when it comes time for them to get their own life insurance, right? Because life insurance at the end of the day is the only asset that you have to qualify for with your health and your wealth, right? So that's the first topic that I want to talk about when it comes to kid policies is if for nothing else, get it because we just don't know what their health status is going to be when they get older and young adults or teenagers of what they're going through in our world, messed up world today.
We're
And
also assuming that at a certain point, whatever the child is going through, they will overcome it or and move on into a place where they have families and they have careers and they have assets and that life insurance policy will really benefit them.
that's right. Now, when it comes to the actual wealth building part, the more fun part about this, there's the aspect of just buying the policies on them as kids if you're not a business owner. Now, if you are a business owner and your kids are on payroll, this becomes super beneficial because what you're doing is essentially taking tax free income that you gave them, that you removed off of your books, gave to them, and now you can move those dollars in their world by way of premium into the whole life insurance contract. And it can build cash value, like we said earlier, tax free when built correctly. Now, the fun part about this, okay, is when you borrow against the cash value of life insurance policies, there's no questions of where it's going to go. There's no um, qualifications like where you want to invest the money, you get to do without the hindrance of anything going on. So I really like this. My family has really enjoyed this because when you look at other areas like 529 plans, well, they need to be used for school, which I think is phenomenal. And you should do those sometimes, right? But what happens if, college doesn't happen in 18 years, which seems like it could be a likely case now? What happens if they want to go to a trade service or a trade school or they just want to be a business owner? Well, now you've got all this money locked up. And if you want to access it, then you can roll a certain amount over to Roth, but then you also have probably more money in these accounts. If it's UTMAs or UGMAs, well, you have to give those accounts to the children when they turn a certain age. Well, what happens if they turn that certain age and you didn't know it yet, but they're not in the right state of mind or they haven't shown to you they have the right characteristics to handle the money the way that they need to, right? With a Roth, great vehicle. I think it's the second greatest vehicle out there. It's great, but there's limits to how much they can put into that and what they can use it for. So with the life insurance, you're able to access the cash value and utilize those dollars for anything you want. So whether it's teaching them how to buy their first car, their wedding, their first home, their first business, whatever it may be, you have the ability to access those funds in the life insurance for all those opportunities. And there's no timeline on when you have to give them that policy. You, the owner, the parent, are in control of when they get ownership of the policy and how they get it and what they can do with it.
So, yes, before they're of age, like right now, I use it to sometimes if I decide I want to use some of it for tuition for one of my kids' college funds, I can borrow that at 5% and pay for his college tuition. And then the other thing that we haven't talked about is that loan gets paid back on the interest, which is generally around 5%, 5.5%. And then if, let's say, I get a little slow on paying that back, it'll just eventually, when I leave this world, will be deducted from that loan will be deducted from the death benefit. And then my heirs and beneficiaries would get the death benefit that's left over.
Yeah, so let's talk about the loans for a moment. So when we borrow against the life insurance contract, it's very important, number one, to get the language right. We are borrowing against the life insurance contract, not from the life insurance contract. So, what's actually happening behind the scenes is when you take a policy loan against your policy, you're giving your policy back to the insurance company as collateral. And then the insurance company is giving you money, their money from their general fund, right? So, number one benefit is that when you borrow against your life insurance contract, you do not interrupt the compound growth of the cash value. So as you borrow against the policy, they continue to pay you interest, they continue to pay you dividends throughout time. Now, when you do take this policy loan, the insurance company determines the interest rate while you determine how you pay it back, when you pay it back, and if you pay it back. So Tamar's point there for a moment is if you never pay the policy loan back, well, what happens is when you graduate, when you pass away, the life insurance company will give your family the death benefit after they've paid off your loan, right? When, the when you pay it back is up to you, whether you pay it monthly, quarterly, annually, never, like we talked about, totally up to you. And then the how is up to you in the fact of do you pay principal and interest? Do you pay a certain amount that you want? Do you pay interest only? You're the one who determines the payment terms around how, when, and if. Now, the insurance company does control the interest rates, right? And that's based on the Moody's Bond Index. And when they do charge it, that interest is charged in arrears. So as you make payments back to the life insurance policy loan, that goes to principal first. So it could be that if you took a policy loan, you could pay lower interest within a given year if you paid off the loan quicker.
Yeah, I love that. The other thing that I want to really emphasize with the loans is that you are really able to leverage here in terms of if you're borrowing at 5% and you have an investment that's making 10%, you're basically have a 5% gain that you're making by utilizing that strategy. And I would also say that when you use the life insurance, I think that it's important to use it as an investment tool. This is actually a great segue into how do sophisticated investors use life insurance in real estate, in business, and other investments. We touched upon, maybe you want to buy a business, maybe you want to buy a house. I've done that very frequently with purchasing my real estate. I will borrow from the life insurance and then pay it back. I want you to answer this question. I also want to add a point. When you are the question of paying back the life insurance, like we said, is up to you. But the one thing to remember too is that if you have money sitting in the bank account and it's earning 0.005%, you can take that money if you have a loan, put it into the life insurance, and then you're not paying that 5.5% anymore. It's just earning that approximate 5 to 5.5%. So we're using that now as a savings account that is actually earning 5.5 that generally you can count on. You're not going to lose your money. You don't have to worry about the FDIC insurance. It's pretty much it's pretty much covered in there. At least it has been for the last several hundred years, which is a good,
Right.
very good track record.
Right.
So I'll let you speak to any of that, and I'd love to hear if there's examples of how sophisticated investors are using for business and other investments other than what I've already mentioned.
Right. Totally. So to your point, you had amazing points there. So number one, like I want to emphasize the fact that you said investment tool. This is not an investment vehicle. It's a more of an investment tool, right? This is not whole life insurance is not going to be your best rate of return, or at least we hope it's not. It's going to be your steady, the tortoise.
It's
It
your
will
bonds.
exactly. It will do what it's supposed to do over the long run and be your never failure strategy, right? And the reason we like to talk about the fact that this is a glorified savings account is most people keep their money in the bank in a high yield savings account. And right now, over the last 2, 3 years, it's been phenomenal to keep your money in a high yield savings account. However, somehow we all forgot that just 4 short years ago, high yield savings accounts barely paid 1%. And so when you have the whole life insurance contract and you're housing your cash in here, you're not worried about interest rates on your high yield savings, whether they're going up to 5% or going down to 0%. You know over time, it's just going to continue to get better and better and better and better. And so this is a phenomenal place to hold your cash, your warehouse of cash over time. Now, one thing we didn't mention on the loan also, which is very important, is there's no questions, no qualifications, no credit checks. There's no effect to your debt to income ratio. When you ask for it, they'll wire it to you in 7 to 10 business days, right?
I usually get mine in 24 hours.
Yeah, it's super, super quick. I think it's phenomenal. Now, when it comes to different strategies that we've seen people utilize it for. So I've bought houses with my policies as the down payment. We've seen people utilize it as the full payment of an entire property with their cash values when they have enough in there. We've had friends of ours, clients of ours do podcast studios. And the reason I love talking to business owners about the whole life insurance is the fact that we're not business owners aren't necessarily that worried about rates of return that they can get in investments. Why? Because they realize they are their greatest asset. They are the rate of return. And so as a business owner, if you start a podcast like the one we're on, let's say you borrow against your policy, you buy all the things that you need for a podcast. Well, think about all the business you could do because you started the podcast, right? We've seen business owners buy, I think of some of my business owners out west in the oil and gas world or the rock world. We are purchasing trucks, utilizing this for trucks where they used to go to the bank to finance their vehicles and then pay them off and utilize it for their business. But every truck that they got, they knew how much their business revenue would grow by. So what we ended up doing is rather than using the bank as a financer, the business owner became the financer. With roofing companies, when they do self-financing, rather than having to go to the bank and getting cut out on the spread that the bank is charging the clients, well, guess what? Why don't we start doing in-house financing? We use the policy's cash value as it continues to grow to help finance the roofing, the different construction type of loans here. We've seen boats, we've seen houses, we've done flips, we've done hard money loans. There are so many things that we have seen business owners use these policies for. And then, the fun ones to talk about are like Walt Disney, when nobody would give him a loan and nobody wanted to sell him a property. So he uses policies to purchase land down in Florida to build Disney World. You've got Ray Kroc, you've got J.C. Penney, you've got, there was a lady who she had a bakery. It's one of the largest cooking
Mrs.
ware.
Fields?
No, not her. We'll have to put it in the show notes, but she used her policy to really get her business off the ground as well.
It's awesome. I love that. That's such a great idea. Let's also segue over to another huge benefit of life insurance, which is the tax conversation.
Sure.
And there are very strategic opportunities inside of owning whole life insurance policies when it comes to taxes?
Correct. So when you think about the whole life insurance when it comes to taxes, number one, the death benefit pays out income tax free, right? Number two, you can access the life insurance by way of loans or withdrawals tax free, right? And the reason that you can withdraw money out of the life insurance tax free up to your basis is because life insurance is one of the last vehicles that runs off of what's called first in, first out. So the first dollars you put in are the first ones you take out. So you can withdraw up to your basis tax free over time. Now, the cash value also grows tax deferred throughout time per the IRS tax code. Per our conversation, if you build it correctly, you'll know that you get the characteristics that it grows tax free for forever. It's kind of like real estate. You know it grows tax deferred, but it's really tax free, and you're just going to 1031 exchange it throughout life, right?
Yeah,
Now,
well, 1031 exchange, we'll talk about that at another time in case somebody in case listeners don't know, but that is a vehicle that, real estate investors use to, sell a property for like value or higher, and then exchange it and defer
mhm.
taxes.
Right. And so when it comes to life insurance, that's like the triple threat. Cash value is going to grow tax deferred, tax free. You get to access it tax free, and the death benefit pays out income tax free. Now with the IRS, those are three very powerful tax benefits that you get with it. What they didn't allow us to do is write off the tax, or we didn't get to write off the premiums going into the life insurance because that'd be a little bit too much. With that being said, there are ways to pay the premiums and write off and deduct things like income that could match the premium to help with that. So you're not actually writing off the premium, but you're writing off the income that you might use to pay for those premiums in different type of strategies with
Can
that.
you give an example of that?
That might be with business owners paying for different type of business owned life insurance policies. So technically what would happen is because you get to write off your payroll, you would be able to bonus income to the employee at hand and pay for those premiums of the life insurance policy. So you're not necessarily writing off the premium, but you're writing off the income that you bonused to that employee.
Right.
Now, the dollars that you pay the premiums with are totally up to you, right? So you could pay with it for earned income, or you could pay for life insurance premiums through assets. So one of the things you're so really just amazing at, Tamar, is talking to women about how do you build a life where your assets pay for your lifestyle, right? You've got all of this passive income. Well, most of the time when we start building passive income, we're no longer playing this game of ordinary income taxes, right? We're paying long term capital gains rates, or it might even be tax free. Well, nobody's stopping you from taking tax free or long term capital gain income and paying the premiums of your life insurance policy either.
100%, 100%. The other piece with the tax, with the ability with tax opportunities inside of the life insurance policy, and I want to touch on it a little bit more. Let's talk about the death benefit again. The death benefit is tax free. That's huge. And I want to just touch on that because with whole life, we know that most of us are not going to live to 114, whatever the policy goes to, and someone is going to benefit from that. Getting tax free money has a huge benefit. One is that you actually, if you have $1 million, $2 million policy, someone can get that $2 million policy. How does that help you when you have an estate? What it does is that, let's say I have a real estate asset and my heirs don't want to sell that real estate asset, but they owe taxes on it if I pass. They can use the life insurance money as a supplement to support. And this is such a great vehicle in terms of, let's say a death benefit comes in and someone wants to use the money to start a business. This is a great benefit for your heirs to think about in terms of estate planning.
That's right. And I think one of the most important things that we need to talk about when it comes to the death benefit of life insurance is the fact that it passes by way of beneficiary. So it does not get held up in probate, right? Probate is the court that you go to when somebody passes away, and then you have to fight out all the things of what's going on. You know, you hear of rock stars and celebrities that didn't do any estate planning, and they're held up in court with all their assets for months, years at a time. And so with life insurance, you don't have to go through probate court to figure out who gets what. On the life insurance application in your client portal, you have your beneficiary designations already lined out, so you know exactly who gets what and when, and utilizing that death benefit is incredibly powerful for the next generation to utilize, whether it's paying for estate taxes or helping just take care of the assets that you so diligently built up over time, and they just need help taking care of it in ways, you know, after you pass.
Yeah, yeah, absolutely. And the other thing that I encourage any listener and of course the clients in my side my mentorship, the women all know that we all want living trusts and we all want to make sure that everything is stated in such a way where it's protected and it has that layer of this is what I want should I pass. So that's another feature. I want to touch on just another level of what life insurance can be for women. And it just, in terms of women and us wanting that layer of security, safety, not having to worry about money, this really creates a layer with this whole life policy. A career pauses, a business is not returning as much revenue, and I need a little help on payroll. I'm working on a lawsuit, like my client, and needs extra money coming in while that lawsuit is being tried. These are all things that really help women to create the financial peace inside of our lives so that we don't need to worry. These questions of as nurturers, we always come up with more what ifs than men, I believe. It's, well, what if this, what if that? Brock is now engaged, so he understands more than many men that aren't ensconced in relationship, that we always think what if, what if, what if, and we'll create the layers of what ifs and create scenarios that stress us out and that throw off our nervous systems. And so that's another reason why I love these type of anchors, whole life insurance policies that create that layer that if someone were to say, well, what if this? Well, you have insurance. I have a client that's a pediatric dentist, and she carries a lot of life insurance and all kinds of insurance for her practice. And she's always saying, I need more money, I need more money, I need more money. And this is a woman that's amassed $25 million worth of, in a business. And when I ask her, why do you need that much more? Well, what if this? What if that? Well, that's why you have insurances in place. So let's talk about uh, the biggest mistake people make when they buy life insurance.
There are a few. I think number one is just thinking, oh, I can just go off the street and just buy it from, or I can just go online and get it offline and I'll be fine. When it comes to life insurance, this is a very important vehicle, asset, protection component of your financial life. It is very important, right? And so I think one of the biggest mistakes is people can just, oh, I'll just get to it and I will, buy it online. It is very important that you work with someone who knows what they're doing, who's an expert in this field, and knows how to coordinate it and integrate it within the rest of your financial life. This is, at the end of the day, we're all going to die at some point. And it's important that you own the assets the right way to allow for what we talked about just a minute ago is the peace of mind. Like you need to work with someone who you know is going to be there when it's needed and can help you structure it the right way throughout time.
Love that. Now, how does life insurance support someone who's working toward financial freedom and not just accumulating more money? We've talked about various ideas already, but I really want to get into this concept because as you know, I speak a lot about the enough number. And the enough number is that number that you need to be financially free. And I feel like a lot of us don't know our number. And so we're chasing more for more sake, and we're stressed out for no reason because we actually have more money than we need, but we're thinking what ifs, and we don't know what that number is. So I help women get to that baseline.
Mhm.
And part of the menu in terms of reaching that number, once they understand that number and learning that enough number, I like to use life insurance. What would you say would be one of the biggest benefits that we've talked about today, or something we even haven't mentioned yet?
Yeah, no, I think that's a great question. I think that when you look at the life insurance, one of those aspects when you're building your wealth is the fact that you can create uninterrupted compound growth. So when you borrow against the cash value to go acquire other assets, you're not interrupting the compound growth on your dollars. They continue to grow. And as you pay them back, it's as if you never touched them. And that, I forget, it was either Charlie Munger or Warren Buffett, but what they talk about, the worst thing that you can do to compound interest is interrupt it. Well, when you utilize life insurance the right way, you are never going to interrupt the compound growth of that money because you're borrowing against it, not from it. You're not taking money out of it. And you're acquiring these other assets by listening to the things that you do, Tamar, to help people build the wealth that they're really trying to get to.
Yeah, I love that. Now, if a woman has been listening to this and she's curious, but she's just overwhelmed, thinking, I don't have the time, I don't know which way to go. What is the first smart step she could take?
I think the first smart step she could take is just meet with us. And let's just go through, hey, A to Z, this is what life insurance is. This is how it works. This is how it's built. Now, if we take a 30,000-foot view and look at your world, here's how it could fit. Now let's go see if we can get you qualified. Because one of the first things that we need to do is fill out an application to see what your health rating is. Because once we see what your health rating is, that really gives us the idea of what's going on. And I think the best thing about filling out life insurance applications, number one, there's no credit check. And number two, you're not obligated to take it. They could issue a policy to you, give you the delivery documents for you to sign and pay, and you could just say, "Hey, you know what? I'm good. I'm not going to take it." So there's no obligation to that. So I think first smartest step, book a call with us. Let's take you through A to Z of what's going on and figure out how it might fit into your world, and then start an application to see what you qualify for.
I love that. Great. And how can people find you and your link?
Yes. So we'll do the calendar link for you guys, and we can put it in the show notes, I believe. So people can book a call with us. And for the listeners, just be sure to put Tamar's email in there so she's always invited. You can find me on LinkedIn. I'm there every weekday posting something. And then as a free gift to your community, Tamar, what we'll do is we will share a link that your listeners can go and get a free copy of What Would the Rockefellers Do?
Yes, and let's talk about what would the Rockefellers do really quickly, because that is such a generous gift, and I love that you're sharing that. Do you wanna share a little bit about that extraordinary book?
Yeah, absolutely. So, what it talks about is the difference between the Vanderbilts and the Rockefellers. So, the Vanderbilts, if you didn't know, were super incredibly wealthy. Like they had more money than the Federal Reserve or the Treasury when they were around at their height. And they're nowhere to be found now. They are not on the wealthiest list of America anymore. Their wealth has absolutely crumbled, and it only took about 4 generations. I think 3 really destroyed it. And you have people like Anderson Cooper, who's a part of the Vanderbilt family, but literally had to fight and fake things to get on to his media role nowadays to show, who he was. And but then you look at the Rockefellers. The Rockefellers are many generations after the first John D. Rockefeller, and they're still on the wealthiest lists in the world. Well, what the difference was the Rockefellers used the things like family meetings, family trust, and then life insurance that helped them perpetuate wealth over time so that as the next generation started their wealth building, they didn't start from zero. They started with a bucket of money that the family knew that they could go to and access and utilize the money if they needed it based on their family constitution and the rules laid out of how they could get the money and utilize the money throughout time.
I love that. That's great. So, in the show notes, there's going to be a link to make an appointment with Brock and put my email address on it so that I can join the meeting. And also, there is going to be a link to getting the book for free, which is amazingly generous. And we'll also be sharing my link to getting your enough number with the calculator and workbook. So we're just full of gifts today. So thank you, everyone. Thank you, Brock, for being here. Thank you, listeners, for taking the time to grow wealth, to understand the value of what it means with women growing wealth. And if you love this episode, which I hope you did, please take a moment and leave me a 5-star review. It helps more women find us. And if you're listening on YouTube, hit the subscribe button. You know what to do. And we will see you next week.
Thank you.